Okay, so just give it a second here. I think it's been a rough start Tuesday for it. I believe it's just maybe it's because it's Tuesday. So all right, so let's see if he's making his way. There he is. Fantastic. Fantastic. I really appreciate are you there, my friend?
Yeah, I don't know what the hell's going on, why it took so long, but it did.
It's okay. They do have new computers, and we stopped using dial-up a long time ago. So it's okay. You can get fiber now. It's okay.
I'm in the city now, man. I'm in the city. Like, I've got great internet here.
I know, but you keep calling it a city. You keep thinking a population of 3 people is a city. We call that a hamlet.
There's only one city.
Whoa, Jim.
Tell me I'm wrong.
For that?
All right. Hey, you know, if we hear a 98 baud modem, then we're in trouble there. But
no, I'm on fiber.
I may take exception to the one city comment, but you never know. We all have our he's proud of New York, but
I love Houston. I love Dallas. I even like San Antonio, but
don't forget about Toronto. Andrew, you gotta remember Toronto.
Toronto's a neighborhood.
Oh, I love it. I love it. What a great way to start. It's Tuesday. It's Rowley. Okay, everyone. Thank you and welcome to the KoreSummit Webinar Series 2021. Once again, we have you can already tell it's going to be an interesting topic today and discussion. So I'm just going to give you the format. My name is Oscar Joffrey. I'm going to be joined with these two great panelists, which they'll introduce themselves to you shortly here. The format is very simple for our KoreSummit. There's no PowerPoint presentations. Here, you're going to be able to have an opportunity to listen to great thought leaders, and you get an opportunity that they're going to chit chat for 45 minutes and discussion points, and then we're going to bring it right back to you for 15 minutes to have questions that they can answer for you to assist you in the discussion we're having today. So it's exciting to have them both with us today because, how to raise your capital for our RegA is a question that we get asked a lot. And there's no two individuals today that are dealing with that question head on. And obviously, we're not going to be able to cover everything today, all the different areas, but we hope to be able to cover a lot of those points that will assist you. This, without a doubt, doesn't mean that our advice is the only advice, and we encourage you to talk to your fellow team members and, of course, those who are helping you with your RegA offering. But hopefully today, this is where the begins of your journey, because 15th of March, 2021, some great news are emerging in RegA. So let's start by getting the introductions going. Jim, please.
Jim Rao with Entoro Capital here in Houston. Entoro is a investment bank. We're a broker-dealer licensed in all 50 states, the District of Columbia, and sometime this week, Puerto Rico as well. We just had a colleague move to Puerto Rico, so we're going to be licensed in Puerto Rico as well. We are also an SEC registered RIA, registered investment advisor. We have, and that's because we have registered funds as well. So we have that. We have a couple funds coming out here in the next month or so. And we're having a family of digital asset funds coming out. We also have a valuation company called Clear Rating, which we're quite proud about. We do a number of principal investments as well through our venture called Entoro Ventures. So we do both principal and agency transactions. Quite involved in the digital and crypto space, and known the Core Connects team for 2 or 3 years, and good friends with Oscar and team. So looking forward to the dialogue, and happy to answer any questions on the broker dealer side of the equation or anything else in the financial world. But if it gets too detailed, I'll have to tell anybody that there's disclaimers and disclosures. So I can only give certain information. So happy to answer as much as I possibly can. Looking forward to it. Thanks, Oscar, for the invitation.
You're welcome, gentlemen. Andrew.
Good morning, everyone. I'm Andrew Korn. I am technically a managing member of E5A Fund, which is our legal name, but we operate as E5A Integrated Marketing. We are a systematic, data-driven investor acquisition firm. 95+% of our work is aimed at helping people acquire investors. We work across financial products, ETFs, mutual funds, real estate, hedge funds, private equity, and of course, RegA Plus. And more recently, as CF is moving to 5 million Reg CF. I am a former multi-factor model portfolio manager and ETF designer. So we have a unique perspective, not only on the math and data side, but also on what investors are looking for, and have managed portfolios exceeding $3 billion. So my team and I work with a variety of issuers, and what we basically are looking for are deals that have a very high probability of success, that have a great team, that have a great concept, and is not just in the concept stage, but is moving along. So I also have known Oscar for a couple of years. I've known Jim for 18 months, 2 years now. Jim has visited my humble city in New York and stopped at our office a couple of times. And I look forward to the pandemic being over and my going to Houston as well, because they have a great food scene there as well.
So are you suggesting we're all moving to Houston? We're following Oracle? I mean, we're following the great one?
First, we have to decide if it's Houston or Houston, but that's a New Yorker's perspective.
I understand. Thank you, gentlemen. It's great. So for all the attendees, thank you for making the time this morning. So let's dive in. Obviously, the big question in your mind today is the topic, how to raise your capital for our Reg A. So, there's a lot of different directions we can take this. And obviously, just for everyone that's here, we have about 72 webinars coming up. So there'll be plenty of time and different specific topics, the legals and all that. But this one will be more general. But I think one of the things that I firmly believe is that there is because of Reg A, things are going to change. And let's touch on that first. There's a big change coming on March the 15th. So Andrew, I mean, you and I have been watching, of course, Jim as well, but this big change, how is that going to affect the way people raise capital, the ability to raise up to 75 million? How is that going to change the way the scope of the offering?
Well, I think it brings Reg A into a new realm. 75 million is a lot of capital to raise. And I think it puts Reg A in more direct competition with traditional underwriting, private equity, not just early stage venture. I mean, at 50 million already, it's a nice chunk of money. But 75, I think, is pushing us much more into what professional investors would say is their own turf. We have already been engaged to work on a $75 million offering. As you know, legal filings take as long as 3 months, and those papers are being drawn, and we intend on raising every dollar of that 75.
Yeah, it is pretty exciting. You are right that it does change the dynamics, the way you think about. I mean, up until now it was 50, and even then it was. But now we've raised it up a notch, and we won't go into the type of offerings that are coming. But Jim, I mean, you're the broker dealer, so Andrew sees it more from the investor acquisition space, how he needs to bring the attraction from a broker dealer. Does anything change for you dramatically now that it's getting changed to 75?
The dollar amount really doesn't change because you go through the same process, whether or not you're raising 10 million or 50 or 75. It does change the context of the investor pool. But the process from due diligence and filings and everything, it doesn't really change. Andrew brought up a good point, though. You're going to get a different makeup because it does start to compete differently. And that's because if you're able to raise $75 million versus where you were able to raise 25, you're able to spread your cost over differently. And you may, where you were going to maybe go for a Reg D, or maybe you were going to go for a different kind of strategy. Maybe a Reg A now makes more sense just from a cost basis of your cap raise. So you'll have a different option where you're able to have a greater amount of it allows you to do something different. So it's a cost basis issue.
Yeah, so I agree with Jim there, and just to kind of segregate those 2 points. First is the quality of issuer. Someone looking to raise 75 million is very different than someone looking to raise 5. Where they are in the business cycle, the way their management team is put together, hopefully their structure is set where they are, quote, prepared to raise that kind of capital and put it to use for the business and for shareholders. So we're hoping that will increase the quality of issuer. And then the second is the cost of capital. When we get to CF, the reason my firm has shied away from CF is there's just a lot of things we have to do that cost X amount of money. And if you apply that against $1 million raise, the cost of capital is prohibitive. So at 75, as Jim said, a lot of the processes are the same. We just need to scale more. And to do that will make us an extremely competitive cost of capital working with a broker dealer like Jim's and a firm like mine.
So that is interesting. I mean, it's always the dollar amount will dictate how you raise your capital, what tactics. I don't think that the overall tactics are going to change. I think we all agree on that. But will it bring a different dimension into the capital raising? Do you think that there is going to, now that it's going to 75, something additional needs to be added to get to that? Because before it was 50 and there was only a few companies that reached that helm. Now we're getting them to the 75. It's having the broker dealer is important, having the investor acquisition. Is there another part that needs to come in that will fundamentally change this capital raise, how it's done?
I think it's going to.
Go ahead. Nope.
My
Jim,
bad.
please,
Sorry,
go
I
first.
should have said Jim first. Yes. Sorry, Jim.
Well, I think it's going to end up. Also factoring in how, from the sponsors, Andrew's, the marketing activity as well. It's going to change as well, because you're going to end up with a greater amount in the market. As you're going to end up with different kind of issuers. For example, and this is, let me give a little sales pitch here from our shop. Because we can do the broker dealer record aspect, but we also have the ability to go out and market as well, right? So we can do twofold. We can actually do the underlying broker dealer record function, but then we also have our own platform where we can reach out to our own set of investors, and then we can also work with other distribution networks, for example RIAs and international. So we our own situation is we can actually bring others to the table. When you have larger offerings, you're going to have a different set of investors that are more interested in a bigger offering, and you're going to see a greater comfort in a bigger offering from that RIA type of community. So that is much more attractive, to some of our investors when you have that. So a $75 million offering is going to get a different, because you're going to see they're also going to be much more likely to be revenue positive, EBITDA positive. I mean, you're going to have a different aspect in the phase of where that particular company is as well.
You brought up an interesting point. I think we're leaning in that direction. I think this is important that we for the greater good of the industry, obviously we're grateful with the SEC increasing it, but it is asking these questions. And Andrew, you were going to bring a point there as well.
Yeah, well, quality issuer is the number one thing that we look for. And, as you know, and Jim knows, as the industry knows, we say no, we cannot help you to an awful lot of companies. It's because they're looking for capital of last resort, because they are thinking that it's easy, or They don't realize they're going to wind up with 20, 30,000 shareholders when this is done, and they need a great transfer agent and tech partner for that side of it. So people need to, or issuers need to really understand what it's all about and why other structures have been in place to help people raise money, depending upon what they're doing, from a 40 Act fund to the way Reg D was done. So, when I look at the way we used to handle 75, which was Reg D combined with A plus is the retail. And that's the mom and pop individual investor, $200,000, $500,000 minimum, where the Reg D might be 25 or 100 or even $1 million minimum, with probably different terms. So 75 allows the whole deal to be on one set of terms, but then may eliminate institutional investors who don't want to have the same terms as someone investing $1,000, because they're putting in way more than that. But at 75, we're going to make a lot of publishers a lot of money, because that is who we spend our media dollars with, along with Facebook and Google and other networks like that. They're certainly going to benefit. My firm works on what we call radical transparency methodology, where all the media is paid for directly by the issuer, with no media markups. So we charge a flat monthly fee, and that works out. 75 is going to probably extend the length of a offering, because it's a lot more money to bring in, and add a lot of complexity, because you can get to audience saturation where how many investors do you really need to be able to get this done? So that is something that we think about quite a bit.
So you both touched on it, but you didn't squeeze the lemon as tight. So I'm going to push it in. So 75 million, I think Jim started touching on it. And I'm just curious. I don't know. I mean, I'm putting the question out there because you guys have seen it. Do you think it's possible that we're getting to the stage where a BD, a broker-dealer or an investment firm, will underwrite a Reg A private deal and, change the landscape? Is that even a possibility, Jim?
It's a possibility. I think you'll see it probably in 2021. I think you're going to see it start to develop as the liquidity of the ATSs starts to become more of a reality. And then I think you're going to start to see it as digitization and tokenization also. I think you're going to see the convergence all happen simultaneously. And I don't think it becomes a stair step. I think it converges simultaneously. I don't think it becomes a stair step. I think one day
they all need to come together, because it's not like ding ding. It's just like that. Okay.
It's not sequential. It's literally going to come, we're all going to meet we're getting there. And even some of the things we're doing in our own shop, we're getting there just by the nature of what we're going to do, and, changing some of the things that we're doing in our own broker dealer to add certain functions and features. We'll get to that point. And then I think if you also see, I think you're going to also see an increase in the size of Reg A at some point as well. I think you're going to see a $100 million number. That'll eventually be a reality as well. I don't predict it in the next year or so, but that'll happen as well. But I mean, when you start to see the convergence between the ATSs, the digitization, the tokenization, all of that kind of coming together, and you're seeing much more of you're going to start to see the reality, the democratization of the capital markets come together, because it was talked about, ad nauseum in 17, 18, and 19. COVID tripped it up, accelerated it, and you're going to start seeing it much more in later 21 and into 22.
Andrew, what do you think?
So I want to take a step back. ATS means alternative trading system, and turning securities into something that's digital essentially should make it easier to trade. So the trading of private securities, essentially all markets are based on supply demand. So when you look at the public markets, even something like the New York Stock Exchange, there are stocks that don't trade for days on end. There are stocks that trade 100,000 times a day, even at 1,000 shares, 5,000 shares. There's all sorts of algorithmic programs to increase liquidity and take large blocks of shares and send them out. So essentially, if you were issuing private shares, is there a market for them? And there's two parts of that. One is the supply demand. The other part is there technology that makes it so these shares can trade hands at a reasonable cost? Is it $500 to make a single trade, or is it $5 to make a single trade? So the advances going on in ATS, alternative trading, and private exchanges is happening at a much faster pace than I was expecting. And certainly, Oscar, you can probably speak to this as well to better than just about anyone, since you and your company are at the forefront of it. Why don't you weigh in on this, as opposed to being the moderator?
No. You know what, guys? I put that question to the both of you because you've both been at this long enough. You see the cycles and all that. And I agree with Jim's point. I think, and both of you are correct. I think things are finally coming together, not in steps. They're coming like this. And I believe that when the SEC increased the limit to 75 million, and I know they were looking at 100 million. So to Jim's point, we are right around the corner of that. That's going to fundamentally change the type of issuers we get, which we're already seeing a more, a company that would have gone more of a traditional route and seen how this is going to happen. And I believe the bankers are coming. Why? Because a secondary market. We now, you're going to hear it here in the next few panels coming up with Sherry Noonan, co-founder of Rialto Markets, the very first registered SEC ATS for digital securities for RegA. I mean, $100 trade. This is, it's not the fact that it's a digital security. This is not a blockchain thing. What people don't realize is that the average individual will never see the blockchain, and they shouldn't have to. Where they're going to benefit is when they go, wow, that was so simple. How did they know? How did they do it? It's all behind the scenes. And that efficiency, to Jim's point, is going to open up the rest. But it's going to take time. It's still, every layer that I keep seeing here, we keep adding to that. So, we're adding a distribution. Andrew, you said it. We need publishers. They're not going to go away. We need them. We need more. We need different venues of publishers. And now, the bankers, that could bring another. And Jim, you're bringing in the RIAs. That's another great distribution channel that has not been made available to companies. So this is opening it up to, it's no longer just crowdfunding. Do you see what I mean?
Well,
you notice that?
I think, yeah, Oscar, I mean, those are all, every one of these components becomes an additive to the benefit of both crowdfunding and the RegA world. But you're also going to start seeing a large expansion, both in the IRA world and 401k space as well, right? So, as some of that space gets untrapped and released, people will start to utilize those avenues as well to take positions in both, A and CF. So that's going to be an ever increasing avenue as well. So it's not going to just be somebody popping down, in a taxable account. You're going to start seeing things done in a lot more in tax-free or non-taxable accounts.
Perfect. So, okay. So we talked about the great thing that it's going to 75 million. We talked about how it's going to change from the investor. It could bring a whole new venue into it. But the real question is how, and the how to is really, I think Andrew, you touched on it, or well, you didn't touch on it, but you were really direct on it. Quality companies, and quality companies can be different stages. I know you've taken pre-revenue companies, their quality, you see the opportunity, to those that are revenue based. But so let's walk through the steps, high level, of course, for people. So obviously, Jim, I'll come back to you from a broker-dealer side, what you need. So Andrew, from your side, what are you looking at for companies to how they should do a RegA from the E5M's point of view?
Yeah, so there's a bunch of reasons why we don't accept everyone who can write us a check. And some of that is the industry itself. We want to make sure that we're bringing good issuers to market and that investors have a really good shot at making money by making this investment. We are not doing formal due diligence. We're not a broker dealer. We're not an RIA. But I have run RIAs, and as a former portfolio manager, I want to make sure that we're working with what we truly believe are quality issuers. So what does that take? As you said, sometimes they're pre-revenue or they're at a minimally, at an MVP, a minimally viable product, but they've got a solid plan. They've got a solid management team. It's not their first rodeo. So it can be their first rodeo, but then they're a little bit more further advanced in what they've got. Why does someone want to do a Reg A rather than going the VC route? You go the VC route, you get 3 or 4 analysts, a partner, get them in a room, convince them, 2, 3 more meetings, and bam, you've got a nice big check. The reason to do a Reg A, and we want to make sure the motivation is there, is that you don't want 3 or 4 people validating your business plan. You want thousands of people to validate your business plan. And you want a bunch of them to become customers as well. And you want a bunch of them to become influencers and advocates. And that is a lot of what we focus on, is making sure that we're bringing that to bear along with the rest of the work we're doing. So, this whole idea of blending is really important. So if the company doesn't have those possibilities, they're never going to work and at scale. And if we do too good of a job, and it's definitely not going to work, I just think that would be a stain on the industry and shame on us for doing that work. So, we are getting tighter and tighter of who we really want to execute for. And, I'm hoping the entire industry starts to accept that as something we need to do to make sure we don't repeat the missteps of when Reg A Plus started.
Yeah, that's a very good point, because when Reg A first got started, it went really high, and obviously a lot of mistakes can happen. And now we're being more cautious. That doesn't mean that we're saying no to companies or anything like that. This is, it's like anything else. You got to come prepared. You can be an early stage company, but you need to prepare yourself. So Jim, from a BD point of view, obviously Andrew touched on some of the final points for yourself. What are companies needing as they're coming to you as well? And of course, what's the role of BD in the Reg A in the first place, right?
Well, Andrew brought up a lot of good points. What the broker dealer does is obviously the due diligence, background checks. We're obviously very concerned with the strength of the issuer ourselves. But the big thing for us is making sure that the issuer can, stand up to with the KYC and the background checks that FINRA and the SEC would require. And that's always a huge issue for me. That gets checked off a little bit with, some of the filings with, the SEC, but that still doesn't relieve us of making sure we take our own independent view of it as well. So those are some of the functions for that. So as a broker dealer of record, we're responsible for also doing an independent analysis of the project. But, on a Reg A, it's much more appropriate, or at least traditionally, a little bit more retail-y focus for a project to pursue a Reg A. Andrew brought it up pretty good that, these end up becoming, this is a marketing piece. You're trying to, if somebody wants to do a Reg A, they may be much more likely to have a retail product than they would a institutional product or something that may never see the light of day in a retail market. So it may be something more appropriate for retail than anything else. So it's a brand building exercise as much as it is a capital raise. But the one thing we're always cognizant of is that every issuer is in love with their product, and not every baby is pretty, and so you have to always figure out whether or not somebody's in love with their baby and sometimes some
I love my
babies
kids, man.
aren't
What are you
that
saying
pretty.
about my children? What are you saying about my new babies? Can't
Some,
you hear him in the background? He's only 6 months old. You broke his heart. Did you hear that,
sometimes not every baby's going to win the beauty contest, right? And that's tough for some people on the you know, that they've nurtured something, or they're ready for, or they think they're ready for prime time, and they're not. And if you really look at a capital raise, whether or not it's on the private side, you know, 50% of a capital raise, and I've said this many times, 50% of a private raise, and that's a D and an A or a CF, and 50% is the management team, and the management team is critical. So there's a lot of trust and a lot of dependency that goes into the management team to getting a funding done and a product launched or what have you. So there's a lot of soft skills that go into figuring out whether that management team is right for you as a broker dealer and right for someone like Andrew to want to work with. And it doesn't mean, I mean, sometimes there's just not a fit. Doesn't mean the project's not going to be successful. You know, I always want to see people be successful, but sometimes there's just not a fit.
Yeah, so
No, I agree.
Jim is lobbing me a softball here to get into data, because data is the determinant, especially if you're going 75, 50, 60, anything north of 10, data is the critical factor from a marketing standpoint. So what do I mean by that? You have, we have a B2B client who we're hoping to sign, and basically they go to, it's going to sound a little boring at first until the end, but they go to domestic dairy farms and they take all that cow manure and they turn that into very low pollution jet fuel. So it's a total B2B play, but who doesn't get that? Oh, cow manure into jet fuel that is almost zero emissions. So that fits the innovation bucket. That fits the impact investing or ESG bucket. So who would want to invest in something like that? And essentially what we're looking at is what buckets does the client fit? How big is that audience? And then if a tiny percentage of them only invested the minimum, are there enough people to fill the raise? If the answer to that very simple arithmetic question is no, there's no reason to start the project from my perspective. If the answer to that is yes, then we should take the next step and see what else we want to do as a measurement. But the data is really important. As Jim said, a retail product, how big is that market? How many in terms of number of people as well as in size from a dollar standpoint? And do we believe we have a really good shot mathematically at fulfilling the raise? And then how can we get to them? Are they identifiable? Can we get data on them? Do we already have data on them? You know, my firm has built almost 1 million person database now that is proprietary, both email and ad tags of verified angel investors, which means they're accredited, but that doesn't mean they don't do CF and A+ as well. So, you know, doesn't mean every single one of them would be interested in every issuer that we're going to work with. It's what percentage and why.
Okay, so we obviously the quality, and I don't agree 100%, Jim, with your point regarding whether it's a company's B2C is more likely to be successful rather than B2B, because I think at the beginning we saw it. I believe that a B2B company will have to work a little bit harder with their messaging, but I think everybody can, but that's neither here nor there. I think you nailed it. There are some people that have a more preference to business to consumer rather than business to business, but we are seeing both. But here's one thing externally, and this will touch on you, Jim, because you're doing it, but I'm going to ask Andrew first on it because we're now seeing it come in. We didn't see it in the early days. We know it's important. It's going to be part of price discovery. We need it for secondary market, and that's research. So we're seeing two different types of research, right? We're seeing First Amendment research, and I'm calling it that. We're all laughing, and it's really important for everybody here to listen to this because we're going to have a topic on this, and it's really important that when you hear First Amendment research, stay away, do not speak to them, because as soon as you do, you can taint your offering. So we'll but then there is a regulated research. I hope I said it correctly, Jim. I'll let you touch it. But how does research fit into all of this on the primary raise, and can it be the catalyst to get companies to the 75 million with the research? Andrew, I'll start with you.
Yeah, so I'm going to let Jim talk about that type of research. As a former buy-side research analyst, published in Barron's and across all sorts of financial media, I take research really seriously. But research today comes in all forms. We place an ad on Facebook or Instagram, and the ad itself gets likes. The ad itself gets comments. And the comment might be, gee, this looks like a Ponzi scheme, or gee, this looks like something I'd really do well with, influences other people. Now, that's not research, but it is commentary that's out in the marketplace. So doing real research is something that my team completely welcomes, because someone with a background in financial analysis and has industry expertise, it's certainly welcome for them to do a third-party write-up. The question is are they paid for the write-up, or are they paid by the issuer for the write-up? And, when you look at the microcap world, there's all sorts of very gray things that go on, and I would want to make sure that that stays out of A+, and certainly way away from CF. So, there can be the straight quantitative kind, and then there can be the qualitative, and then they can be put together. So I know that Jim has more expertise, especially in A+ on research, than I do. So I'm going to ask him to jump in.
Well, Oscar brings up a good point on research. This is, we have a whole series of webinars on this topic alone. Research can be either regulated or non-regulated. Under the broker-dealer, there's actually licensing for it, 8687, FINRA licensing. You need to be approved by a broker-dealer to actually issue certain things on buy, hold, sale kind of activity. Then there's the unregulated side. Then there's even insurance. There's a number of things. I don't want to go too deep in it. And then there was recent activity in Europe under MiFID II, which basically killed off a lot of the Wall Street research things. Like I said, I don't want to go too deep. But for Reg A, Reg CF, true research is actually difficult to come by because it is effectively private, and it really is comes from the sponsor promoted side of the equation. I don't want to be a promoter of my own organization too much, but we actually have a division, a subsidiary called Clear Rating, which we actually do that. There's a couple other groups that also provide research and will provide third-party reviews for Reg A and Reg CF transactions. Those are actually quite valuable for a issuer because anytime you have a third-party review for a offering, that's, to me, is always a beneficial thing. Even if it may have a certain amount of bias to it, at least it's another third, it's more information. The more information you can get, at least it allows the reader, the potential investor, to make a judgment call whether or not it is beneficial or not. So to me, even if slightly biased or biased period, it at least allows someone to make a judgment call on that piece of research or documentation. A news story may or may not be research. A article, a vlog, or blog, etc., may or may not be research. To me, something that is actually somebody's reviewed the financials, reviewed the comparable competitors, reviewed the industry. That to me is research. Just making an opinion that this company is good, bad, or indifferent, that is not research. Taking an intellectual and an honest view of it, that to me is research. And that's what we do. And we actually do a pretty thorough review of a company. And like I said, most of those are usually sponsored by the issuer to provide that activity. And that is usually something for them to say, hey, we're opening ourselves up. We'd like somebody else to do a third-party review of us, so we're not just, eating our own message, but we're actually exposing ourselves and allowing someone else to come in and write about us. And when you have that, to me, that's always a good sign that somebody's willing to do that, and that usually is a good sign to investors. And when investors see that, they're much more willing to, typically invest in that type of a company and a project because it usually has that independence to it. So to me, that's research. It'll improve. There'll be more people in the space, but it's a costly thing. When you're writing a research report for a private company, when you're only going to see a $5 million offering or even up to a $75 million offering, that's an expensive proposition compared to a Wall Street report on Apple, right? It's a very different thing to spread the cost over, a $1 trillion company versus somebody raising $50 million. So it's a very different mix. You'll see it, gain strength over the next few years. We ourselves at Clear Rating, we're, ramping up to have our goal is to have 100 ratings a day. That's where we're shooting for. That's our first phase.
Okay. Yeah, I'm torn by it. I see more of it coming out. I know that the goal is to put information out there that's going to help investors have a better insight into companies, and some of it can be misleading. I think you need, in particular, I mean, maybe Reg CF is a little different because it is smaller amount, but even then, I mean, if we start limiting ourselves to saying it's a smaller amount, it's okay. I say any amount is not okay. There should be qualified individuals doing the work so it can provide a report that investors can rely on. I mean, the only question I'm going to ask you, Andrew, I know sometimes you're not, but do you think it can have a positive impact in a company with a report, regardless of who does it? I mean, can it be the catalyst?
Absolutely, without question.
Yeah, so I need to agree with that. What I'm looking for, and it's a very big undertaking. If you go to something like Yahoo Finance, they look at every single company the exact same way. So there's a uniformity, and they are not doing research, but they're presenting you a bunch of statistical things the same way. So if we, as an industry, were able to do that and say, here's a bunch of ways we assess it. Now, a company just writing research is one thing. A broker-dealer writing research is another, because they've got a different standard to conform to. So if we could get things that are, truly qualified people, like anyone can write anything. There's a company out there called Estimize, which crowdfunds earnings estimates and all sorts of other typical estimates. And it can be done by a high school kid in their basement all the way to a buy-side analyst at a multi-billion-dollar hedge fund. But they've got algorithms to figure all that out, and they do a great job. They've got an 8-9 year head start on us. So, Jim jumping into this, I think, is admirable, and we definitely need more of it, not less of it. I just think a bunch of standards need to be created so that people are looking at apples to apples.
It is. This is a standardization issue. I've been working on this since 1992. I can tell you it's not an easy thing to standardize, and the amount of efforts we've worked on it from our own shop is not an easy thing to try. I mean, given some of the new tools out there, I can tell you AI and a number of other things is going to massively change the world. And when it comes to ratings and some of this stuff, it's going to change. But let me tell you, it's not an easy subject. It's not and not one size fits all. I mean, the way you analyze a software company is a very different way than you analyze a manufacturing or an energy company or anything. Yeah. It's the methodologies are massively different from a retail company. It's just very, very different.
Yeah, but the exciting thing, sorry, Andrew, I was just going to say, the only exciting thing about all this We're talking about it finally. We weren't talking about it 2 years ago, 3 years ago. Today we're talking about it because people are thinking that this is going to be needed. And like anything, whenever you introduce something new, it's kind of crumbly, it's a little bumpy, but we're having the discussion and we're alerting the audience to make sure they understand when they hear about this, what impact it can have, because it can have a positive and negative impact on your company as well, depending on who you're dealing with.
Well, I can tell you from our, the authors of our, we will never have someone's name on a document because it could be counterproductive to it. But the people that actually work on it are CFAs, CPAs, lawyers, industry experts, finance, subject matter experts, right? That's how you have to have it. And you can tell that by the quality of the materials. Because if not, you have there's no value in it.
There's nothing. Sorry, Andrew, I didn't mean to cut you off. I just
No.
wanted
All it's going to do is give a measure of, if you look at debt to peer group on a software company, well, there shouldn't be any debt. Oh, but it's so small it has a convertible note. But you look at debt to peer group on an industrial or manufacturer, that's a normal thing to look at. So Jim's point of that it's all different is, and how complicated it is, it was easy for me to build a model on public companies because of Reg FD and back when Sarbanes happened and everyone had to put out their financials the same way. Doing it on private companies is a nightmare, and my hat's off to you for tackling it.
Well, the difference between here's how you know somebody knows what they're doing. If they try to compare a lot of private companies to public companies, and they try to draw those proxies together as an investor, that's when you turn around and walk out the door. Because there, that's not a good analogy.
Thank you, gentlemen. We had a great discussion. I mean, it wasn't the how-to. This wasn't it. We wanted to give you kind of the overview of RegA. It's going to 75 million. The dynamics are going to change. It's like we're walking all over again. But the only difference is we've learned the basics. Front, right foot, left foot, and walking along. But there's new dynamics coming in that it's going to fundamentally change the way you raise your capital. You got to think of all these different elements that didn't exist 2-3 years ago. And the great thing is we have this ecosystem that you don't have to go too far to learn it, because here's the experts. They've done it, so they're going to be able to tell you what is working, what isn't working. So usually what we do now is we leave the last portion of the webinar to you, the attendees that are here. All you need to do is click the button, raise hand, if you have some questions for our panelists here this afternoon that may be pertaining to a RegA you're looking at doing, or some question about the regulation itself. You have a broker dealer, you have an investor acquisition expert here. So you're getting it from both sides, from the person that's bringing in the investors to the table to the one that's processing, as well adding distribution. And so, okay, so far no questions. Look at that, guys. You guys must have stunned everybody today. There's no questions at all. So, wait, Richard Ross has a question. I'm bringing him in here. All right, Richard, you're on.
Can you hear me okay?
Yes.
Oh, great, thank you. It seems, extending with what you're talking about, by the way, you guys are great, that there's a new way of funding companies that completely disintermediates VCs, starting with incubators, going to Reg CF plus and A plus, ending with SPACs. Am I completely wrong, or is this actually a thing? Thanks.
Andrew, I'll let you start first, answer that.
Yes, I just don't know if it ends in a SPAC. It could end in an acquisition of some sort. It could end in an IPO. We all want to think about and talk about exits, but we are really focused on the hard work of raising that initial capital. And then, a CF can be round one. And we actually advise companies. So let's start with, I'm not a broker dealer. I'm not an investment banker. I did play one in a high school play, but that doesn't really make me one. But I have been around a lot of deals. I got my start writing IPO roadshows for major investment banks. This was my first job out of college. So what I do see is that we advise a lot of companies to start with the CF that come to us for an A, now that it's $5 million. Raise the $5 million, accomplish a bunch of things, and then come to us at an A so that you can raise your valuation. If you want to raise $75 million and your company's worth 25, you raise 75, your valuation's at 100, you now own 25% of your company, or you and your angel investors own 25% of your company. Not a great outcome. So there's a lot of things still to think about. It is not like this is a pot of gold. And then the second thing is it's really hard work. So that's basically my answer.
Jim, your view, my friend.
Richard, I think it's I think you're correct on the disintermediation, but I don't think I would go and say that this is the end of VCs by any stretch of the imagination, for a couple of reasons. It was kind of like 30 years ago, everybody thought we were going to go paperless, and we ended up using more paper than we've ever used. And I think it has a little bit to do with, I think it's just another option. And I think VCs do serve a function for some companies just need VC work. Some can do Reg CF, some can do A. I think it's more options. I don't think you're ever going to say, oh, it eliminates VCs. So I think it's just another option out there. There's some management teams that get, kicked out by VCs are just not the right thing. The other thing is that VC funds just get bigger. And that has a lot to do with LPs just being lazy and not wanting to do direct deals, but just think it's easier to do portfolio, just make a portfolio investment in a VC group because they're experts in picking who's going to be the winner. They don't realize that the average VC fund now is 17 years long, but that's a different story. So I don't think I would go ahead and pronounce the death of VCs. I think you're just going to see more options for issuers to raise more direct funds. And as the market matures, as we said, with ATSs and providing liquidity and some of these other things, you're going to see more interesting structures, and you're going to see things that I think are going to be more beneficial to the issuers than just beneficial to the VCs.
Yeah, I'm gonna dive in on this one because I've always felt that it was kind of the two buckets, but now I'm seeing something different. I'm speaking from personal experience in our company. We were fortunate enough to get 3 VCs. They're small VCs. I mean, they're only managing probably less than $500 million in their portfolios. But the important thing is that they're starting to see. I think Jim touched on an interesting point, which was we were very transparent and said, look, we're going to do this round and we're going to do our Reg A. And, so you're not relying on them to come up with a follow-up on it, which typically, and we did say no to certain VCs not because they didn't like the deal, we didn't like them, is that they didn't want us to do a Reg A. And for us, it was really important that we did that route. So I think it's just as important. It's not whether it's, Jim touched on, whether VCs are good about, they're not. There's a certain place they fit. They serve 2% of the market. We need that. The 98% of the market, you can have a mix and match. And I think we're going to see that. PitchBook said it best. With Reg CF, Andrew recommends most clients, he's not a bank or anything, that you should do a Reg CF if you can, because you can raise up to $5 million now. It's in a great stepping stone to do a Reg A to 75. So it's, but you're moving down this journey. This is a journey. And this journey doesn't mean that you cannot include private equity group, family offices, venture capital. Quite the opposite. They're starting to understand, wait a minute, I don't need to hang on to this thing for 10 years. I'm going to have liquidity, to Jim's point. So I think it's educational, and I think we all need to work together because VCs do bring something quite valuable. They bring validation. They can assist the company to grow. They bring mentorship, things that sometimes companies do not have. You can have thousands of investors, but you need growth to help you scale. Well, that's where, so it's a give and take. Sorry, Andrew, my apologies.
No. All those are really good points. I just wanted to also bring up, sometimes when you do the CF first, you find out the answer to an important question. Are you a lifestyle company or are you a scale company? Because the business plan may look really good, but it may end up that it's going to be a very profitable company for yourself and a couple of hundred shareholders because you did it as a CF, but it's not going to become a $500 million company ever. And in that case, you probably shouldn't be doing the A+. And definitely that's why VCs may have said no, is they just don't feel that the market is ever big enough that you're going to grow to where they will receive a multiple on their investment that will make them feel good, or make their LPs give them more money to manage. So there's a lot of motivations going from the different groups, and a lot of it has to do with, you might have a great idea and it's a great company, it's just not a scale company. So that's something else to be determined.
Yeah, agree. So today, obviously, I hope for everyone, this was a kind of an overview. It's giving you a different perspective into RegA, things that you don't think about, but they are part of the strategy. In fact, that there is another part. We got about 5 minutes here, but I think we're touching on it right now, and we don't talk about it enough. And it's giving me an idea that I think we need to include it. We've been going that you need a broker dealer, you need a lawyer, you need the auditors. But what we're not talking about with these companies is how to structure your deal. And structuring your deal is to understand, to your point, Andrew, what is it? Is it you just want to hit here and that's it? What's the journey? Because that is going to help you structure whether you need to do a Reg D or a Reg CF to go there. So there's a lot of questions that need to be asked by the entrepreneurs and their team and their advisors. And obviously, we sometimes get involved in that, and yet we're not qualified. So we're certainly not. We always push and say, listen, you should be talking. So where should that conversation start?
Can I jump in on this one? Because this is a hot
Are you
topic
sure
for
you
me.
want to jump in? No, I don't know. Should we let him?
Yes, let me jump in on this one.
He's from Houston, so we'll let him.
Yeah, no, we'll just correct it, Houston, but that's okay. I actually used to be head of a structuring group for a major corporation for a while, to be nameless, but always a sensitive thing to me. And most people don't understand the concept of structuring. And I would argue that most finance guys don't understand the concept of structuring. And I would also argue most lawyers don't understand the concept of structuring. And I would say that most of them do it poorly. And it has it's not something that you learn overnight. And it's usually takes a combination of both legal and financial to figure out what is the best solution for a particular company, and to really do whiteboarding and structure and brainstorming to figure out what's some of the best avenues for a particular company. And it may not be something that just gets worked out in the first 30 minutes of any conversation. So it Oscar, that actually is a webinar all on its own, and it could literally be you could do some scenario analysis and go through. That if you want to talk about a webinar that would literally add a lot of value, that is something that would be.
No, I agree with you, Jim.
That would be a great way to do things, and bring in case studies and go through it. I mean, it's a perfect thing to do case studies on them. What would you do? And it would be interesting to have the dialogue between have a tax person, a broker dealer I'm just getting at that's the way you have this. And sometimes there's not a right or wrong answer. There can be a combination of answers, and it all depends. I mean, there's a number of factors that go into this. The capitalization, that it can be crazy things at time of the year, where the company is in its life cycle. There's 10 factors that go into at a minimum of what might be right for a particular company.
No, thank you. And you're right. As we were talking about it, just dawned on me that we didn't. Andrew, I'd love to hear your. You and I deal with this all the time, right?
So I sometimes give a little homework assignment to issuers and say, buy the E-Myth, the Entrepreneurial Myth. It's available as a book. It's available as an audiobook. It's a very quick read, and it really talks about what it takes to turn a small business into a scale business. And then with that, you can communicate with professionals like Jim and lawyers and really be able to structure a deal well. But the valuation example I gave, I think, is really important for people to understand. We want to go out and raise 15 million, and currently we're valued at 7. How'd you get that 7 number? So if you don't know how you got that 7 number, you need to know that before you talk to a broker dealer. So because, you know, they have a duty to make sure that valuation is fair. So
Valuation's the third question always asked.
It's okay, guys. It's okay.
What are the first
only
two
at,
questions?
I'm only at
What do you
3/4 of
do?
a
How much
billion.
do you want? And what's your value? Those are the 3 questions. They never change.
I'll remember that. All right, everyone. So look, we started peeling it. There's obviously a whole series behind this. We are going to create a webinar specifically to how to structure an offering, which obviously it will be high level. It won't dig all in, but it's to get your mind thinking. I think can you repeat that book again, Andrew? I think I got it. Entrepreneurial Myth, E-Myth. Okay, and it's available as an ebook and audio, right? Correct. Okay.
yes, and a paperback as well.
And a paperback. Okay. So obviously we're giving great tidbits. All of you here today as well. We're providing you a free ebook as well. It's Equity Crowdfunding 101. It's just the basics. I mean, it goes more into detail of due diligence and how to prepare. But obviously today we talked about the new dimension of where this is going with RegA is up to 75 million. So I do want to thank everybody for coming out today, this morning, listening to these two great individuals. Don't worry, we'll be sending you their details so you'll be able to reach out to them and contact them and be able to ask away your questions. We do have another webinar this afternoon at 3:30 this afternoon. I hope you can make it. We are obviously trying to cover all the items that you wanted to hear and listen to our speakers discuss. And this afternoon, of course, it's the infamous topic that we have, RegA end to end. So this is it's going to be exciting. It's really to go high level again, but again, we're touching on the areas so you get a grasp of all the things you need to be aware. So you come prepared. So when you speak to the lawyers and the auditors and people like Andrew, you have most of the information you need. Still a lot of work ahead. So I want to say thank you to everyone today. All of this is available on YouTube. Just go to CoreConnex. You can subscribe. This was on Google Live. So the video will be available in about 3-4 minutes right after this, so you can watch it again. So I want to say thank you, Jim, as always. It's great to see you in Houston, Texas, and Andrew in your small city of 3 people. We'll be talking again soon, the 3 of us. So have a great day, everyone. Cheers.
Thanks, Oscar.
You're very welcome.
Good to see you again, Andrew.